Hello, fellow traders. 'Tis I, the Rumpled One, coming to you on Tuesday, July the 20th. The year's 2021. Let's talk trading. Good trading is repetitive. So is bad. Part 2. This video, like the others, is for educational purposes only. Your results may differ from mine. Yesterday, Walmall gave his take on the good trading is repetitive, so is bad. And one of the things I noticed was a comment um, about the Walmall method. And there's one trader out there on YouTube was saying he's been taking 3 and 4 pip losses. And if he had waited, he could have made a profit. So if you think about this title, good trading is repetitive, so is bad. Now, one thing, I usually don't like to use good and bad. I like to use desirable, undesirable, or preferable, unpreferable, because those aren't so judgmental, where good and bad is judgmental. But when it comes to trading, I like to say profitable, unprofitable. So profitable trading is repetitive, so is unprofitable. So if this trader is following the Walmall method and they're taking these 3 and 4 pip losses, there's probably a pattern there to be discovered. So for example, maybe the trader went short here only to take a loss. Now we're looking at the M5 chart right here, and Walmall always says he usually waits for the second touch. So maybe this trade would have been a loser no matter what. But then if you look at this candle here, the low never hit the double zero. So you had one touch, failed second. Now here's your second touch here, and it obviously broke through, and there was a chance for a win. But let's take a quick look down on M1, and let's see what happened. So going back, this is M1, but you can see here, it hit it, and it actually went down to 98.6, your body temperature, right? And if you didn't grab that, 1.4 pips on the very next candle, it would have put you down. It would have gone against you 1.3 pips. That's nothing to worry about. And then as you can see, there was a chance to pick up a possible 5.3 pips if you waited that entire time. So what's that tell you? Well, maybe if you're taking these losses, maybe you need to wait. Don't take that first touch. Or maybe you're not following the Walmall method, because you're only supposed to take a 3 pip loss if you had a 3 pip gain. And the question is, if you had a 3 pip gain, why are you watching your pips flow out of your account? Watching the dollars flow out of your account when you think about it. You're up 3 pips. Now, if you have a small account, let's just say you're trading $1 a pip. $3, big deal, right? Wrong way to look at it. Think in terms of pips, because maybe when you're trading for $100 a pip, 3 pips is $300. That's folding money. And would you let that slip through your fingers? So that's one of the things why a lot of times we'll talk about pips rather than dollars, even though it's the dollars that count, because you can make a lot of pips, but actually lose money because you have that one trade that went against you, that maybe you were over leveraged, or you had a little more risk than you were supposed to. But that's kind of a different story. Point being is, look at what you're doing, look for the pattern, and see what you need to either change or start or eliminate. So in this case, maybe you have to eliminate taking that very first touch and wait for a second touch. Now, also looking at this, knowing Walmart, since we trade together just about every day, we would call this a return bar. And you see, price came down to about the halfway point here. So I know if Walmart had taken this trade here at the 36.10 level, because I'm not sure, let's see, find where the hours started. So it looks like the hours started here. So yeah, so maybe here he would have taken it, and on this one he would have taken it because this would have been the short line. So this really wouldn't have counted actually. But in this case it might have. This case it would have counted. So you can see here, he would have taken that. He probably would have saw it hit that midpoint, and that's probably where he would have taken profit, knowing that price will do that more often than not. So in fact, on this candle here, which looks like a return bar, you can see here it broke just below the midpoint, but then reversed. So when you see it getting to those areas, it's time to start taking profit. So that's just one of the things about, good trading is repetitive. So a lot of times, when people are winning, they're not so apt to analyze their trades, but that's when you almost have to really analyze the trades, because you might be getting double lucky. One, you're lucky if you win, but you might be doing some things that aren't quite according to plan that you're doing, and you're just the market smiling upon you and letting you get away with it for the time being. So you have to be cautious of that too. And the trader that kind of prompted this whole idea was saying how he was getting bored with these trades because he rarely loses. Some people might scoff at that, but no, I can definitely understand it, because you're sitting here in front of the screen, ho hum, prices at the line, take the trade, ho hum, take your profit, wait, wash, rinse, repeat. You're doing it over and over, and it can get mind-numbingly boring, especially if you have a really simple method where you don't have to do a bunch of analyzation. I mean, you just sit here and you're just waiting for price to get to a certain point on the chart. I mean, you can actually put your pending orders in ahead of time and just sit here with your head in your hands watching the chart, or maybe not even watching, waiting for an alert to let you know you're in a trade. And that would be it. In fact, that gave me an idea. Maybe I should write an indicator, the in a trade um, indicator, where if you're not in a trade, zero open trades, and all of a sudden it sees you have a trade open, it'll alert you, because maybe you have a pending order out there that you forgot about, and now it will alert you and say, hey, you've got a pending order out here. You need to pay attention. Or your pending order just got filled. You need to pay attention. So I'm going to write that down in a trade alert indicator. Open trades. Okay, so back to the point of the video. Well, you can see right here, it tried the line, pulled back just a hair, tried it a second time on the M5. It actually went up to a high of 11. So maybe you take that pip, maybe you don't. If you don't, now your stop loss would be at entry -7. So you sit and you wait. and you wait, and you wait. So, which is tempting now that you're waiting to want to start messing with things, maybe adding another indicator to the chart or monkeying with your method as opposed to just doing what the method tells you to do. So what I would look for, this isn't quite a return bar to me, but you got a high of 10 and a low of 1, so probably somewhere around 5, 6 area. If this price pulls back, look for it to bounce, and if it goes and closes below it, it just might be a dead trade or a loss. But anything can happen, so you have to let it play out. And that's why you have your plans ahead of time. And part of doing your plans ahead of time, knowing these things, your exit playbook, your money management playbook, that adds to the boredom. It adds because it's repetitive. And so if you're making good or profitable trades, you're doing it over and over, yeah, you're repeating things that are making you money. Or on the other hand, if you're losing money, you're repeating things that are losing your money. So either way, it's repetitive. So it just behooves you as a trader to do things that are profitable rather than not. And the biggest thing you can do that's repetitive is just employ your risk management. Because for the most part, once you enter a trade, that's what you're doing most of the time you're in the trade. And part of that is also your brain management. I think brain management probably comes in more on the entry side than on the exit side, but it can be difficult when you're in a trade like this one right here, because on the one hand, you've been up a pip, you've been down a pip, and it's like, come on, just go, just give me another pip. You start to say things like that. And then as you can see, price goes against you slightly. And then it comes back and it seems like you've entered at an inflection point, which is something I'm really good at for some strange reason. So a lot of times I'll have to fight my way out of trade. And when I say fight, what I mean is I'll add in because I believe that the trade's still going to go a certain direction. Now, right here, you're up 2 pips. Do you take it? Because if you took it, now you said I just left one on the table. You look left, you see you're in a bunch of wick zones. I mean, you don't have clear sailing out of wick zones till you reach last hour's high. Look at that. So it's starting to stall. You still got 2 pips. Do you take it or do you wait? Because it could drop down to that 10 in a blink of an eye. It's stalling. Is it going to push? What do? You see I've got 1, 2, 3 green candles in a row. You look left. I had 1, 2, 3, and then it went red. I had 1, 2, it went red. I had a big 1, it went red. A 1 red, a 1 red. So right now, just looking at that, are you pushing your luck? You can look at some more candles. Well, you see you had a 1, 2, 3, 4. Right now you've got 4. Maybe it's going to go. We're near the half hour. You're just going to have to wait and see. But you're up 4.8 pips. So, fellow traders, I hope you enjoyed that commentary today. And just remember, when you sit down at your trading platform, it's not what you trade, it's how you trade it. So, go out there and drain the banks. And once again, if you happen to pick up my Reddit thread, I'd appreciate it if you would join it. So, this is the Rumpled One, over and out.